Okay, so is Coinbase, the exchange we all sort of saw as the top dog? Are they actually facing maybe an existential threat now?
It's a really valid question,
Yeah.
and that's exactly what we're digging into today. We're looking closely at what's going on sort of under the hood there.
Yeah, taking a hard look. And we're basing this on, well, a pretty critical article, right? Coinbase business model breakdown and critique.
Exactly. It's a candid look.
Yeah.
It dissects where things might be going wrong, the challenges they're really up against.
And it's key to point out, I think, that this critique isn't coming from someone who just hates Coinbase. It's more disappointment, like they could be doing better.
That's the vibe, yeah. So our goal today for you listening is to unpack these arguments, understand the potential pitfalls Coinbase faces, and pull out the key stuff for anyone interested in crypto, business strategy, all that competitive stuff.
Right. So let's start with the beginning. Coinbase. I mean, everyone knew them. First big name in the US, huge first mover advantage, massive brand recognition.
Oh, for sure. If you were in the US getting into crypto early on, Coinbase was probably your first stop. They
Yeah.
absolutely nailed that initial phase.
And this is the core of the critique, isn't it? Have they actually built anything sustainable? Any real competitive advantages or moats, as they say?
That's the million-dollar question, isn't it?
Yeah.
Are there actual, defenses protecting them now that everyone else is piling into this space?
And the analysis really zeroes in on this specific tweet from back in April 10th, I think. It
Yeah.
kind of crystallizes a lot of the worries.
Yeah, it's interesting how one tweet sort of bundles up all these concerns. Let's break it down a bit. First off, their main trading business.
Okay.
The argument is, look, for just buying and selling crypto, Robinhood's got a slicker interface, right? And you can do stocks there, too, all in one app.
Yeah, that integration is a big deal for a lot of people. Why juggle apps?
Exactly. And then on the other side, you've got the big traditional finance players, the bulge brackets. They have the infrastructure, the pipes, maybe better suited for massive volume trading eventually.
So squeeze from both sides, potentially? Okay, what about custody? They were early there, too.
They were. But the critique says, well, where's the tech advantage? Is it really that special? And now you have huge trusted names like State Street, BNY Mellon getting into crypto custody.
Right, institutions might feel safer with those established players. Makes sense. Okay, then the stablecoin thing. USDC revenue. What's the issue there?
So Coinbase makes money, interest income, from USDC. But the article points out a couple of things. One, that income depends heavily on interest rates staying up. If rates drop, that revenue shrinks.
Okay.
And maybe more importantly, as the market gets smarter, users holding USDC might start saying, hey, where's my cut of that interest if competitors start sharing yield?
Coinbase looks less attractive. Got it. The tweet also apparently hits hard on customer sentiment, just straight up says customers hate them. Ouch.
Yeah, pretty blunt. It suggests customer service quality is a real pain point.
Yeah.
And in finance, well, bad service can really kill you long term.
Definitely builds resentment. And then it mentions poor acquisitions and management decisions, like buying back debt.
Right. The example given is repurchasing 0% debt, which, financially makes you scratch your head. Why use capital on debt that costs nothing? It raises flags about maybe strategic thinking.
Seems odd. Okay. And the last point from that tweet snapshot, token listings.
Yeah, the accusation is basically favoritism, listing tokens that Coinbase Ventures, their own VC arm, has invested in, while maybe ignoring other potentially good projects. They mention one called Hyperlid as an example.
That hints at potential conflicts of interest, doesn't it? If listings aren't purely based on merit or demand, that can erode user trust. Okay, let's shift gears slightly. The article also discusses their choice to go public via a direct listing, not a traditional IPO. What was the criticism there?
Well, the author sees it as kind of a missed opportunity. Going direct might have seemed cool, very crypto, very anti-Wall Street.
Right, sticking it to the banks.
Maybe. But the critique argues it missed out on the crucial part of an IPO, which is educating investors, really building the market's understanding of your business.
Yeah.
They didn't really sell the story.
So less effort in winning over the traditional investment world.
That's the argument. And interestingly, the article floats the idea. Couldn't they have done something more, well, crypto, like a tokenized stock? Something that really leaned into their own world instead of a kind of halfway house direct listing? A missed chance, perhaps, to innovate how they went public.
Let's talk revenue, because initially it was all about those fees, right? High retail trading fees, like up to 3% sometimes.
Oh, yeah, super high. And you know that Jeff Bezos quote, "Your margin is my opportunity"?
Yep. Classic.
Well, that's the risk. When you have margins that high, you basically paint a giant target on your back. Competitors will come in offering lower fees. Margin compression is almost guaranteed.
So those fat margins were never going to last. The article says they tried to diversify institutional stuff, custody, stablecoins, but then adds the kicker, poor execution. That's an example of that.
The analysis gives a really concrete one. The clunky connection between Coinbase custody and the main Coinbase exchange.
Okay.
So imagine a big fund using custody wants to trade some of those assets on the exchange. Apparently, it can take up to 48 hours to move the assets internally.
Wait, 48 hours? Just to move between two parts of the same company?
That's what the article claims,
Hmm.
which, compared to traditional finance prime brokers where that stuff is instant, it sounds incredibly inefficient.
Wow. Yeah, that's not going to work for serious traders. It highlights a real lack of internal synergy, doesn't it? Like the different parts aren't talking to each other properly. And that inefficiency maybe opens the door even wider for someone like Robinhood, which the article clearly sees as a major threat.
Definitely. Robinhood's big advantage is that unified experience. Crypto and stocks, same app, slick interface. For a lot of users, especially maybe newer ones, that's just easier.
Convenience is king, right? Manage everything in one place.
Exactly. Why bother with multiple apps if you don't have to? It puts pressure on Coinbase's core trading offering.
Okay, so going back to the weaknesses in those core areas. Custody-facing giants. Stablecoins, the revenue model is called broken. Let's dive into that USDC model again. How does it actually work, and why is it broken?
Right, so let's clarify the flow. Circle is the company that creates and manages USDC. They partner with big players like BlackRock to handle the actual cash reserves backing the coin. Coinbase is then a key platform where you, the user, can get and use USDC.
Got it. Distributor role.
Yeah. Now, here's the thing. Those reserves, sitting in banks or bonds, earn interest. A lot of interest. The article uses Tether as a parallel, estimating they might make something like $13 billion a year in interest.
$13 billion just from interest.
Huge numbers. And the critical point is, if you're holding USDC on Coinbase, you typically get zero of that interest. It goes to Circle, BlackRock, Coinbase.
Ah, okay. I see the problem.
An argument is that's just not sustainable. As competition heats up, someone's going to start offering yield back to the users. Why would you hold your stablecoin somewhere that gives you nothing if you can hold them somewhere else and earn interest?
Yeah, the pressure to share that yield seems inevitable. It helps to know where this critique is coming from, though. What's the author's angle?
Yeah, they're quite clear. They state they have no financial position in Coinbase stock, so it's not about shorting it or anything.
Okay, no direct financial motive.
Right. And they mentioned that critique stems from actual business dealings with Coinbase via Arca, which is a digital asset management firm. So it's framed as coming from experience, from seeing the execution, or lack thereof, up close. It reads more like frustration, disappointment, and unmet potential, not just trying to tear them down.
So, putting it all together, what's the final assessment from this analysis? Is Coinbase doomed or just struggling?
I wouldn't say doomed is the word used. It's more like misaligned,
Okay.
poorly integrated. They have these different parts, retail trading, institutional custody, stable coins, but they don't seem to work together smoothly.
The synergy isn't there.
Exactly. And that, combined with the potential customer service issues and maybe some questionable strategic moves, it creates significant risks. They could absolutely lose that dominant position if they don't address these core problems, pretty seriously and pretty quickly.
Okay. So, for you listening, the big takeaway from this critique we've unpacked is that Coinbase, despite its strong start, faces some real fundamental challenges to its business model and competitive position. It's not untouchable.
Definitely not. Which leads to, I think, a really interesting final thought. You look at how fast traditional finance is changing, how fast fintech is moving, and what users clearly want: seamless experiences, real value.
Yeah.
So what does Coinbase really need to do? Is it about doubling down on tech? Or is it something more fundamental, like a deep shift towards truly benefiting the user, integrating everything properly? Could that be the key, not just to survive, but to actually thrive long term? It's something to chew on as this whole space keeps evolving.